What's going on, you guys? My name is Zach Hartley, and in this video we are going to talk about stock buybacks. Why does a company buy back its own stock? How does it work? What happens to that stock? And I'm going to give you a Pokemon reference so that it's very easy to understand. Here's everything you need to know. Let's go. Okay, so a stock buyback is when a company goes out into the market and they buy its own shares. An example of this would be Berkshire Hathaway spending their own cash on Berkshire Hathaway stock. I use Berkshire Hathaway as an example because that's Warren Buffett's company, and Warren Buffett is a very well-known person that buys back his own stock, or at least Berkshire Hathaway buys back its own stock. Another example of this is Apple. Both of those companies have a history and a tendency to buy back their own stock. Now, what happens when Apple or Berkshire go out and they buy back their own stock? Well, when a company buys back its own stock, those shares become part of the treasury shares, which are not included in the shares outstanding. So remember, when we calculate our market cap or what the company is worth, that is based on the shares outstanding. And when a company goes out and they reduce the number of shares in the market and they convert those shares from basically publicly traded shares to treasury shares, it reduces the number of shares outstanding. And the common impact that usually has is it increases the price because it reduces the supply of the available shares in the market. So when a company goes out and they buy back their own shares, what is happening there is that those shares are being converted from publicly traded and available shares to treasury shares that are no longer available to the public. They're basically taking off of the public exchange, almost as if you were destroying those shares. They no longer exist, and this reduces the supply of available shares in the market. And if the demand stays the same, that usually drives up the price. Now, that is caused by the supply and demand. And just like I said, if the demand remains the same for Apple shares or Berkshire Hathaway shares, nothing changes in the business, and the same number of people still want to buy those shares, the price of those shares is going to go up because the number of shares available has gone down. It's kind of like, the best example of this is Pokemon. And so, for instance, everybody knows now, thanks to Logan Paul, that the holographic Charizard card is the rarest Pokemon card that you can get. Some of them are worth hundreds of thousands of dollars. And so if this was happening to, let's say, the Pokemon world, the example here would be if Pokemon, the company, went out into the market and they bought half of the available Charizards in the market and they destroyed them. Those cards no longer exist. Pokemon went out and paid a bunch of money for them and they destroyed them. Now, of course, Pokemon could always just go out and make more Charizard cards if they wanted to, just like a company can go out and issue more shares. But as of right now, once those cards are destroyed or once those shares have been converted into treasury stock, they no longer exist. They're not included in the market cap, and those Pokemon cards aren't available in the market. And so because of what just happened there, those remaining Charizards have become more rare. The supply of them has decreased. However, as long as nothing happens and people still believe in Pokemon or still believe in the company, the value of those Charizard cards or the value of those shares will increase because the demand is still there, but the supply has decreased. And so that's probably the closest example I can give you to what a share buyback program is without actually giving you a company example. Now, one thing you might want to know is how to tell if a company is buying back its own shares. And there's three different ways you can do this. Number one is definitely going to be the most solid way to do it, and that is to look at the financial statements. Number two is going to be to look at management interviews. So often when management is buying back shares, they will talk about that in interviews that they conduct with the public. Or lastly is previous history. If you notice that Apple throughout its history has bought back its shares when the company hits a PE value of X, or when the share price drops to this level, the company buys back shares. Those two different kind of indicators can help you get a better understanding of whether or not the company is buying back those shares at the current moment. However, the best answer for this is always going to be in the financial statements. And when you look at the financial statements, the quarterly report is called the 10Q report and the annual report is called the 10K report. I just pulled Apple's most recent 10Q quarterly statement, and in there they have a note 7, shareholders equity share repurchase program, where they actually break down for you everything about their purchase program, what they're buying it for, how many shares they're buying. And right here you can see that Apple, the company, repurchased 200 million shares of its common stock for $24 billion. Obviously, these numbers are rounded a little bit, but you can see that Apple is very clearly buying back its own stock in the numbers of $24 billion in a single quarter. You can also see this on the statement of shareholders' equity. It is this line item right here, common stock repurchased. Again, you can see it right here, $24 billion. And so this is going to be the number one way to figure out if a company is buying back its own shares. Secondly is going to be management interviews. And then thirdly is going to be looking at the history if you are curious about it and you just can't find the information. Now, there are some risks when you see that a company is buying back its own stock, because that means that the company is spending its own cash on buying its stock instead of expanding its business. And so there are some risks or some red flags that you need to be aware of. The number one risk that you need to watch out for and that you need to be careful of is when management decides to buy back the stock of the company to give themselves a short-term return. So if I'm the CEO of Apple and I own a ton of Apple shares and I know that I can get the price of those shares to go up if I spend company money buying those shares and taking them out of the market, that is management spending company money to give themselves a personal short-term reward. And that is what you want to avoid. That is a huge red flag. That is market manipulation. And you need to be very careful of that. You need to very carefully examine the motives of management and why they are buying back that stock. Because if the reason behind that purchase is to make them rich, you need to avoid that company like the plague. Secondly is that buying stock does not help the company grow its operations. If Apple goes out and spends $24 billion buying back its stock, that's $24 billion that it is not using in R&D and expansion and opening up another store in all these different areas. Now, with Apple, you have to take it as a grain of salt because this company has usually at different times of the year has more cash than any other company in the world. So $24 billion on its own stock isn't a big deal for Apple. But if it was a company that was half or a quarter of the size of Apple, then that would be a massive, massive concern that you may want to look into. And the last thing is that you need to ask yourself, if you were the management and you were the CEO of this company, would you rather see the company invest in expansion and growth or in buying back their own stock? You need to ask yourself that. If the stock is trading at a massive discount and the company can spend some money and get that back up, then maybe that's great. Maybe that's a fantastic thing. But if the company is already trading at a premium and they still buying back the stock, that may be a very big red flag that you need to look at. Now, my thoughts, every situation is different. There's no blanket statement that buying back is good or buying back is bad. You need to be very careful with those kind of blanket statements because usually it doesn't apply in every situation is different. What you need to think about is if you are the management team looking at your company and looking at the stock price and looking at your cash balance, what is the best thing you can do with that cash? Because you don't want to leave it just sitting as cash. Sometimes it's better to convert it into stock or into an asset or into growth for the company. So if you were the CEO, how would you manage your cash balance? And stock buybacks can be good if they are done with the right intentions and the company has more cash than they need. Those are the situations that I look for and I approve when a company is buying back its stock, when it has the right intentions and when it has more cash than it needs. Now, if you are interested in learning more about the financials, understanding the stock charts, and analyzing companies to find an entry and exit point, then definitely consider signing up for my stock market fundamentals course. It is hosted on Skillshare and there is over 9 hours of content on there that will walk you through step by step exactly how to get started in the market. There's over 3,100 students that have already gone through the course. There's over 160 plus reviews, and I would love to have you there. I promise you it will be the best free online resource that you can find when it comes to the stock market. The link is in the description down below, and it is hosted on Skillshare. Now, in summary, I've got that free course. I also have a Discord chat link down below, but you need to be very careful when a company is buying back its own stock. Make sure that it is a great company. Make sure that they have a healthy balance sheet. Make sure that they're doing it for the right intentions and the right reasons, and make sure they are not doing it to make management rich. Those are the things that you need to watch out for. And if you get any value from this video, make sure to hit that like and subscribe button. I sincerely appreciate it, and we'll see you guys tomorrow. Good luck trading. Good luck investing. Talk to you soon.